Our lesson for this video is broadening formation, definition, example, and trading strategies. A broadening formation, also known as a megaphone pattern, is a chart pattern in technical analysis characterized by two diverging trend lines, one sloping upward and the other downward. This pattern reflects increasing price volatility, with each successive high being higher than the last, and each low being lower than the previous one. Broadening formations indicate market uncertainty, where prices swing more wildly as traders struggle to establish a dominant trend. The key features of a broadening formation: higher highs. Each successive peak surpasses the previous one. Lower lows. Each successive low falls below the previous one. Increasing volatility. The price range widens over time, leading to larger swings. Trend indecision. The pattern may precede a breakout in either direction, as the market tries to establish a new trend. We have two types of broadening formations. Broadening top. This forms after an uptrend. It indicates potential bearish reversal. Higher highs show continued attempts at upward momentum, but lower lows reveal increasing weakness. Second is broadening bottom. This forms after a downtrend. It suggests potential bullish reversal. Lower lows highlight extended bearish pressure, while higher highs indicate buyers stepping in. Example of a broadening formation for better clarification. Imagine a stock that has risen steadily for several weeks. Suddenly, the price starts swinging wildly. One day, it hits a new all-time high. The next day, it drops sharply, setting a new short-term low. Now, this pattern continues over several weeks, with each peak higher and each dip lower than before. When you plot this stock's price movements on a chart, connecting the highs and lows with trend lines reveals a broadening triangle pattern. Moving on to the trading strategies for broadening formations. Trading a broadening formation can be challenging due to its unpredictable nature and heightened volatility. Here are some strategies to consider. 4 things. Trading the breakout. Wait for the price to break out above the upper trend line, which is the bullish breakout, or below the lower trend line, which is the bearish breakout. Enter a position when the price closes firmly outside the pattern's boundaries. Look for increased trading volume during the breakout to confirm its validity. Then, place stop-loss orders just inside the pattern to manage risk in case of a false breakout. Range trading. Trade within the pattern by buying near the lower trend line and selling near the upper trend line. Enter long positions when the price approaches the lower boundary and shows signs of reversal. Close the position when the price nears the upper boundary. Place stop-loss orders slightly below the lower trend line to limit potential losses. Divergence analysis. Use momentum indicators like the RSI Relative Strength Index or MACD Moving Average Convergence Divergence to identify divergences. If the price forms lower lows but the indicator forms higher lows, it suggests weakening bearish momentum. If the price forms higher highs but the indicator forms lower highs, it signals weakening bullish momentum. Lastly, volume analysis. Monitor trading volume closely. A breakout accompanied by high volume is more likely to be sustained. Combine volume analysis with trendline breakouts for higher confidence in trade decisions. Easy to understand, yeah? You can see this class as much as you can. In addition, broadening formations are dynamic patterns that reflect growing market uncertainty and increasing price volatility. While challenging to trade, they can provide profitable opportunities for traders who use disciplined strategies and risk management techniques. I await your questions at the comments. Thanks for watching.